Money Power Fraud presents the 1MDB scandal using sovereign funds for private laundering. Chapter 1. Executive Exposure, a sovereign fund engineered for extraction. One Malaysia Development Berhad was launched in 2009, a state-owned investment fund created by the government of Malaysia. Its mandate was positioned as national development, attract foreign capital, finance infrastructure, build long-term economic capacity. In structure, it resembled a sovereign wealth fund, but it did not behave like one. Traditional sovereign funds deploy surplus reserves. 1MDB raised capital through debt. Billions were borrowed, primarily through bond issuances arranged by Goldman Sachs. This is the first structural break. The fund was not allocating existing capital. It was manufacturing capital inflow, debt-funded, rapidly scaled, externally legitimized. That legitimacy mattered. Participation by global financial institutions lowered perceived risk. Before internal controls were validated, control inside 1MDB was highly concentrated. Strategic authority aligned closely with political leadership, including then Prime Minister Najib Razak. This created the second structural condition, capital authority without independent governance. From here, the system becomes predictable. Large volumes of borrowed capital entered the fund, but were not deployed into transparent productive assets. Instead, funds were routed through layered structures, joint ventures, offshore entities, multi-stage transfers across jurisdictions. Each layer reduced visibility. Each transfer increased distance from origin. Transactions were presented as investments. The underlying function was diversion. More than $4.5 billion was misappropriated, not through a single transaction, but through a sequence of engineered capital flows, processed across multiple jurisdictions, handled by institutions designed to detect irregularity. This is the core exposure. 1MDB was not simply mismanaged, it was structurally permissive, a sovereign-backed vehicle with debt-driven inflows, weak governance separation, and engineered opacity. Under those conditions, capital does not just circulate, it becomes extractable. This episode isolates that mechanism, where the capital entered and how it was redirected, and why the failure was structurally inevitable. Chapter 2. System Formation, Political Authority Embedded in Capital Structure. One Malaysia Development Berhad did not begin as a fraud mechanism. It began as a politically anchored investment platform. Its origin traces to a state-level entity, the Terengganu Investment Authority. That entity was federalized, rebranded, and expanded into 1MDB. This transition matters. Control shifted from regional oversight to centralized national authority. At the center of that authority was Najib Razak. He was not only prime minister, he also chaired the advisory board of 1MDB. This created structural overlap, political leadership, and capital allocation were no longer separated. In a properly governed sovereign fund, there are layers of control, independent boards, risk committees, investment mandates with constraints. 1MDB compressed those layers. Decision-making became concentrated, approval pathways shortened, oversight became discretionary. This is the first system vulnerability. When capital authority is centralized, control becomes conditional, not procedural. The second vulnerability emerged in mandate design. 1MDB was positioned as a strategic investor, but without clearly enforced investment criteria. There were no strict requirements for return thresholds, transparency standards, counterparty verification. This created flexibility, but not productive flexibility. Operational ambiguity. Ambiguity allows reinterpretation. Reinterpretation allows manipulation. From this point, capital deployment does not require strict justification, only narrative alignment. The third vulnerability was speed. 1MDB scaled rapidly, large capital inflows, complex transactions, short time horizons. This reduced the ability of internal systems to evaluate risk properly. High-velocity capital overwhelms weak governance. At this stage, nothing illegal is required. The system is already permissive. Centralized authority, ambiguous mandate, high capital velocity. These three conditions form the base layer. They do not create fraud, they make fraud executable. Chapter 3. Capital Aggregation, Debt-Fueled Scale, and Institutional Validation. 1MDB did not grow through investment returns. It scaled through capital raising. The primary mechanism was debt. Large bond issuances executed in rapid succession at multi-billion-dollar scale. Between 2012 and 2013, 1MDB raised approximately $6.5 billion. These bonds were arranged by Goldman Sachs. This step is critical. Institutional underwriting creates credibility. It signals legitimacy to the global market, but it also compresses scrutiny. When a top-tier bank structures the issuance, counterparties assume baseline due diligence has been satisfied. This creates a validation loop. Capital enters faster, questions decrease, complexity increases. The bond structures themselves were unusual. High interest rates, elevated fees, accelerated issuance timelines. These characteristics indicate urgency, not long-term capital strategy. The fund was not optimizing cost of capital. It was optimizing access to capital. This distinction defines the system. Debt becomes the fuel source, not a supporting instrument. Once raised, capital required deployment, but deployment discipline was weak. There was no enforced alignment between borrowed capital and productive asset allocation. This creates a structural gap. Capital inflow exceeds operational control. At this point, the system transitions from capital formation to capital vulnerability. Large inflows, compressed timelines, reduced scrutiny. These conditions create pressure to move capital quickly, without friction. That movement becomes the next layer, because once capital is raised at scale, the question is no longer how to generate returns. It becomes how to route the funds. Chapter 4: Obfuscation Layer, Offshore Structures and Transaction Layering. Once capital entered 1MDB, it did not move directly into operating assets. It moved through structures. The primary mechanism was layering. Funds were routed into joint ventures, then into intermediary entities, then into offshore controlled accounts. Each step altered visibility. A central example was the partnership with PetroSaudi International, marketed as a strategic energy joint venture positioned to justify large capital transfers. Approximately $1 billion was committed, but a significant portion was diverted immediately, transferred to an entity named Goodstar Limited, registered in the British Virgin Islands. This is where the structure becomes explicit. The transaction appeared legitimate, documented as part of a joint venture, but the counterparty was misrepresented. Funds did not remain within the investment structure. They exited into a controlled offshore vehicle. This is classic layering. Input, bond proceeds. Transfer, joint venture allocation. Diversion, offshore entity routing. Outcome, loss of traceable ownership. From here, the model scaled. Additional entities were introduced across multiple jurisdictions: Switzerland, Singapore, Luxembourg. Each jurisdiction added complexity. Different regulatory standards, different reporting requirements, different enforcement timelines. This fragmentation slows detection. Financial institutions process transactions based on localized compliance rules, not system-wide visibility. That creates a gap. No single institution sees the full chain, only individual segments, and each segment appears justifiable. The structure does not hide transactions, it distributes them across entities, across borders, across compliance systems. At this stage, the capital is no longer centralized. It is dispersed, and once dispersed, it becomes significantly harder to reconstruct. This is the obfuscation layer, not concealment through secrecy, but concealment through structure. The system does not rely on invisibility, it relies on fragmentation. And fragmentation, when combined with institutional trust, becomes highly effective. Chapter 5: Exploit Mechanism, Controlled Counterparties and False Transaction Logic. Once funds were layered through offshore structures, control shifted to counterparties, not independent counterparties, controlled ones. This is the core exploit. Transactions were presented as external investments, but the receiving entities were not truly external. They were aligned with Joe Lowe. He held no formal executive role inside 1MDB, but functionally directed capital flow coordination. This creates a critical condition: control without accountability. The mechanism relied on misrepresentation. Counterparties were described as strategic partners, investment vehicles, debt repayment entities. But in execution, they operated as controlled endpoints. The transaction logic followed a repeatable pattern. Input: bond proceeds enter 1MDB. Reclassification: funds labeled as joint venture investment. Transfer: capital routed to intermediary entity. Diversion: funds redirected to controlled offshore accounts. Outcome: ownership obscured, control retained. Each step was documented, but documentation does not equal validity. If the counterparty is misrepresented, the entire transaction becomes synthetic. This is not theft through disappearance, it is theft through redefinition. Funds are not removed, they are reassigned from institutional balance sheet to privately controlled structure. The system scaled because it appeared executable. Each transaction had legal documentation, bank processing, institutional involvement. That creates procedural legitimacy, but the underlying control remained centralized. At the counterparty level, this is the key failure point, due diligence focused on transaction form, not counterparty reality. As long as the structure appeared valid, the flow continued. And once the flow continues at scale, detection becomes reactive, not preventive. At this stage, the system is fully operational. Capital enters, is reclassified, is transferred, and is absorbed without immediate interruption. This is not a single exploit. It is a repeatable system, one that converts institutional capital into privately controlled assets. Chapter 6. Institutional Shielding, Compliance Systems That Did Not Escalate. By this stage, the system was not hidden. It was processed. Through regulated financial institutions, global banks handled the flows, cleared transactions, validated documentation, key intermediaries included Goldman Sachs and Deutsche Bank. This introduces the next layer, institutional shielding, not active concealment, but passive allowance. The transactions carried signals, large dollar values, unusual routing patterns, complex counterparty structures. These are standard risk indicators. Anti-money laundering systems are designed to detect exactly this profile, but detection requires escalation, and escalation depends on incentives. The incentive structure inside institutions was not neutral. High-fee transactions generate revenue. Large sovereign-linked deals carry prestige. This creates friction between compliance signaling and business incentives. In that environment, borderline transactions are processed, not blocked. Due diligence was performed, but within narrow scope. Verification focused on documentation completeness, transaction authorization, not on ultimate beneficial ownership, full capital flow reconstruction. This is a critical distinction. Compliance validated the form, but not the substance. Cross-border fragmentation amplified the gap. Transactions moved through Singapore, Switzerland, United States. Each jurisdiction applied its own controls. No system had full visibility. Each institution saw a segment and not the entire chain. This prevents pattern recognition. Even when individual transactions appear unusual, they do not trigger systemic alarms. Because the system is not observed holistically, at scale this becomes protective, not for the institution, for the flow. The structure leverages institutional trust, jurisdictional separation, incentive misalignment. Together, these create a processing environment where high-risk capital continues to move without immediate interruption. This is the shielding layer, not because controls were absent, because they were insufficient relative to the structure being executed. Chapter 7, Asset Conversion, from illicit flow to tangible ownership. Once capital cleared institutional channels, it required transformation, not movement, conversion. At this stage, the objective shifts from concealment to stabilization. Illicit funds are not held as cash. They are converted into assets that appear legitimate, transferable, and defensible. The 1MDB structure followed this exactly. Diverted capital was deployed into high-end real estate, art acquisitions, luxury assets, media financing. This is not random spending. It is strategic placement. Real estate provides store of value, jurisdictional anchoring, apparent legitimacy. Art provides subjective valuation, low transparency, ease of cross-border movement. One high-visibility example was funding tied to the film, The Wolf of Wall Street. The capital entered as film financing, but originated from diverted sovereign funds. This is conversion through narrative. The source of funds is replaced by the function of funds. Once capital participates in a legitimate activity, its origin becomes harder to challenge. Ownership structures further reinforce this. Assets were not held directly, they were placed under shell companies, trust structures, layered ownership entities. This creates distance between asset and beneficial owner. At this stage, recovery becomes complex because the system has transitioned from financial traceability to legal ownership structures. Even if the original flow is identified, the asset now exists within a different framework, protected by property law, jurisdictional boundaries, ownership claims. This is the final stage of the laundering cycle. Capital is no longer moving. It is embedded inside tangible systems with legal recognition. From here, the system appears complete, but it remains fragile because conversion does not eliminate traceability. It only delays it. And once external investigation begins, these assets become the entry point for system unraveling. Chapter 8, Trigger Event, External Exposure, and Forensic Convergence. The system did not collapse from internal controls. It was exposed from outside. Initial signals did not come from regulators, they came from investigative reporting. Journalists began tracing anomalies, unusual capital flows, inconsistent disclosures. A key early catalyst was reporting by the Wall Street Journal. This introduced public visibility. Once public, the system changes. Institutions that process transactions become exposed to scrutiny. Regulators are forced to act. At this point, fragmentation begins to reverse. Previously isolated transaction segments are reconstructed into a unified flow. This is forensic convergence. Data from multiple jurisdictions is aggregated, compared, aligned. The same transactions that appeared isolated now reveal pattern continuity. Capital movement becomes traceable. This triggers formal investigation. A central escalation came from the U.S. Department of Justice through asset seizure actions and civil forfeiture complaints. This matters structurally. The system relied on jurisdictional fragmentation. Enforcement introduced jurisdictional coordination. That removes the protection layer. Financial institutions are reevaluated. Transaction histories are reopened. Counterparties are re-identified. At this stage, opacity fails, not because the system changes, because visibility increases. The narrative of investment is replaced by evidence of flow manipulation. Once this threshold is crossed, the system cannot stabilize. Confidence deteriorates. Political pressure increases. Institutional exposure expands, and the model begins to unwind. Not gradually, but through compounding scrutiny. This is the trigger point, where a structurally permissive system is forced into transparency. And once forced into transparency, the outcome becomes inevitable. Chapter 9. Collapse Dynamics, Political Displacement and Financial Containment. Once exposure reached regulatory scale, the system could not absorb the pressure. It fragmented. The first layer to destabilize was political. In Malaysia, public trust deteriorated rapidly. Allegations tied directly to Najib Razak, not as indirect association, as direct financial linkage. This changes the collapse profile. When political authority is embedded in the system, exposure becomes regime risk. Elections followed. Leadership changed. This is not typical financial fallout. It is systemic displacement. The second layer was financial containment. One MDB retained the debt. Billions in obligations remained outstanding, without corresponding productive assets. This creates asymmetry. Liabilities persist. Assets do not. The burden shifts to the state. Public balance sheets absorb the failure. The third layer was institutional consequence. Global banks faced scrutiny. Investigations expanded across jurisdictions. Penalties were imposed, most notably Goldman Sachs agreed to multi-billion-dollar settlements. This reflects a delayed accountability model. Transactions are processed in real time. Consequences are applied years later. During that gap, the system operates fully. The fourth layer was asset recovery. Authorities initiated seizure actions across multiple jurisdictions, real estate, financial accounts, luxury assets. But recovery is not equivalent to reversal. Once capital has been converted and dispersed, full reconstruction is unlikely. Partial recovery becomes the ceiling. At this stage, the system is no longer operational, but its effects remain. Debt persists. Legal processes continue. Institutional reputations are recalibrated. This is the collapse phase, not a single failure point, a multi-layered unwinding, political, financial, and institutional, each reinforcing the other. And once all three layers engage, the system does not stabilize, it terminates. Chapter 10. Systemic Interpretation, Why the Outcome Was Structurally Predictable. The one MDB failure was not an anomaly. It was a predictable system outcome. The structure contained four reinforcing conditions. First, debt-funded capital at sovereign scale. Borrowed funds introduce pressure. Capital must be deployed quickly. This reduces scrutiny. Second, centralized authority over allocation decisions. Control was not distributed, it was concentrated. This removes internal challenge mechanisms. Decisions are executed, not questioned. Third, weak governance separation, political leadership, and fund oversight were not independent. This collapses accountability layers. Oversight becomes symbolic, not functional. Fourth, cross-border structural opacity. Capital moved through multiple jurisdictions, each with different reporting standards, different enforcement timelines, no single authority, had full visibility. These conditions do not create fraud directly. They create permissive architecture. Within that architecture, capital becomes vulnerable, not at the point of entry, at the point of control. The system did not require concealment. it required coordination. Once coordination is achieved, execution becomes repeatable. This is the key insight. 1MDB was not a one-off scheme. It was a model where debt supplies capital, authority directs flow, structures obscure movement, institutions process transactions. Under those conditions, failure is not random. It is mechanical. The collapse appears complex, but the logic is simple. When capital flows exceed governance capacity, control is lost. And when control is lost, inside a sovereign structure, the consequences scale accordingly. This is why the outcome was inevitable, not because of individuals, because of system design. Chapter 11, Operational Implications, Modern Risk Signals and Exposure Mapping. The 1MDB structure is not historical. It is replicable. The same conditions exist today across sovereign funds, state-linked entities, and quasi-public investment vehicles. The objective here is not analysis, it is detection. Start with capital formation. If a fund is raising capital through debt rather than deploying reserves, risk increases, especially when issuance is large, frequent, and rapidly executed. This indicates pressure to deploy capital before governance can validate use. Next, examine control structure. If decision authority is concentrated near political leadership, risk compounds. Look for absence of independent boards, external audit enforcement, clear investment mandates. Without separation, oversight becomes optional. Then evaluate transaction pathways. If capital moves through multiple jurisdictions, offshore entities, layered ownership structures, visibility declines. Fragmentation is not neutral, it is a risk multiplier. Focus on counterparties. If counterparties are opaque, recently formed, or difficult to verify, stop. This is a primary failure point. Most systems fail here because due diligence focuses on documentation, not on control reality. Next, assess institutional behavior. If major financial institutions are involved, do not assume safety. Institutional participation is not validation, it is throughput. Transactions can be processed without being fully understood. Finally, monitor capital velocity. High-speed movement of large funds is not efficiency, it is risk signal, especially when paired with complex structuring. These signals do not confirm fraud, but they define exposure. And exposure, when left unaddressed, it becomes systemic vulnerability. This is the operational takeaway. Do not analyze the outcome. Identify the structure early, because once the system is fully active, intervention becomes difficult. And once capital is dispersed, recovery becomes partial. Chapter 12, Strategic Defense, How to Operate Inside Structurally Compromised Systems. The 1MDB case is not just analysis, it defines defensive requirements. If you operate in capital markets, you are exposed to similar structures. Defense begins with verification, not surface-level verification, structural verification. Start with beneficial ownership. Do not rely on named counterparties. Trace control. Who ultimately directs the entity? Who benefits from the transaction? If ownership cannot be resolved clearly, the risk is not ambiguous, it is elevated. Next, analyze transaction pathways. Do not evaluate a single transfer. Map the sequence, where capital originates, where it moves, where it terminates. Fragmented visibility is a failure condition. If you cannot reconstruct the full path, you do not understand the exposure. Then assess jurisdictional layering. Multiple jurisdictions are not inherently risky, but they introduce enforcement gaps. Each additional jurisdiction reduces coordination, delays response, complicates recovery. Map jurisdictional risk explicitly. Do not assume alignment between regulators. Next, evaluate incentive structures. Ask a simple question. Who benefits if this transaction proceeds? If intermediaries earn disproportionate fees, risk increases. High compensation often correlates with structural complexity, and complexity often masks underlying weakness. Then reassess institutional trust. Do not outsource judgment to reputation. Participation by major institutions does not eliminate risk. It can accelerate exposure because institutional systems process at scale. Finally, control capital velocity. Speed is not neutral. Rapid movement of large funds reduces intervention windows. Introduce friction intentionally. Delay execution, increase review layers, require multi-point validation. Friction is defensive architecture. Without it, capital moves faster than oversight. And once that happens, control is lost. This is the strategic position. You are not preventing fraud globally. You are preventing exposure locally by identifying structural risk early and refusing to participate when the system cannot be verified. Because once the structure is active, you are no longer analyzing it. You are inside it. Chapter 13. Closing. Sovereign capital does not eliminate risk. 1MDB is often framed as corruption or political scandal. That framing is incomplete. The more accurate interpretation is structural. A sovereign entity was used as a capital routing system, backed by state legitimacy, fueled by global debt markets, processed by institutional finance. That combination is powerful. Because it reduces resistance, sovereign backing signals safety, institutional participation signals validation. Together, they suppress scrutiny, but neither replaces governance. This is the core lesson. Legitimacy is not control. When governance is weak, legitimacy amplifies risk because more capital enters, faster, with fewer challenges. The 1MDB structure did not fail at the end. It failed at formation, centralized authority, debt-driven capital inflow, opaque transaction pathways, misaligned incentives. Once those conditions existed, the outcome was fixed. The exposure simply revealed it. This is not isolated to one fund. The same architecture can exist anywhere. Sovereign vehicles, state-linked enterprises, and private investment platforms. If the structure matches, the risk profile matches. This is the final position. Do not evaluate systems based on reputation. Evaluate them based on structure, because capital does not respond to narrative. It responds to control. And when control is absent, even sovereign systems become extraction mechanisms.